Andrew Holland, CEO of Avendus Capital Public Markets Alternate Strategies. Andrew, great having you. Thank you so much for joining in. And at the onset of this, season's greetings to you, Sonal, and everybody at home. Have a great Christmas and a festive season.
Thank you, Niraj, and thank you everyone here and the team. Wish you all a very happy Christmas and obviously to all the viewers.
Yeah, thank you so much. Could it be that? I mean, we've had the opposite of a Santa Claus rally for world markets by and large, including India. Can that change, Andrew, in the near term?
You know, you could have this kind of bounce off the bottom, a bit of a rally towards the end of the year. But I don't think it's business as usual when we go into 2025. I know there was a lot happened last year. You can say markets were resilient, including our own, despite geopolitical, despite all the kind of changes in terms of interest rates and so forth. But I think, you know, it's a one-way ticket at the moment, right? It's America only, America first, America's the only place to be. I'm not sure it's going to quite work out that way, but, you know, until President-elect Trump, you know, takes office on the 20th of January, I think it's going to be a volatile time. We're already seeing statements he's making, you know, which will have an impact. Europe's under pressure, China will be under pressure. So I think you're just sitting on the sidelines and just waiting for some of these plays to come through. It's probably not a bad strategy. So holding a bit of cash ahead of these kind of developments, I don't think it's a bad strategy at the moment.
Are you sitting on cash right now?
Yes,
yeah?
We're highly hedged and have a lot of cash. Because, you know, see for our markets, right, let's just say we're in a range between 23 and 25 on Nifty. When you get up towards that 24 plus, what's the catalyst? There's no real extra catalyst now, because earnings are going to be downgraded again in the come January. We know the economy is slowing very quickly. 6.8 seems like too high to me for GDP growth. It's going to be nearer to 6, right? We saw from a Siemens analyst, you know, review that they're starting to see a slowdown, even though they're expecting government capex to pick up. It's not happening.
Yeah.
So until you get all of these starting to play through, that multiplier effect, which will help earnings, is going to be a problem. So I think revenue and margins are going to be under pressure continuously.
So Q3 expected to be dull. The counter could be that has been sort of priced in to some extent. Any hopes from what the budget could bring in? Could that be the catalyst you're talking about?
Okay. So in terms of earnings, you know, what we've seen is analysts downgrade share prices, not necessarily earnings. Yeah. So I think after the first, you know, come January when we see the results, I think they'll downgrade again. And if the economy is slowing from 6.8 to 6, there's a lot more to come. As regards the budget, yeah, I mean, we all get excited about the budget. I mean, every year, last time we talked about it as well. Now, you know, given that it seems to me that we just seem to increase taxes, I can't be looking for a tax reduction come the budget, right? So I don't think the budget's going to save us.
Could the budget spoil the party or not really? We had 2 budgets in the last 12 months already. The third one will not necessarily come and spoil the party.
Well, the hope is that they won't do anything with capital gains tax. But that's a trajectory which you know is going higher.
Yeah.
They have to take that kind of, you know, income, the kind of bond 40% tax and equities 12.5. There's a big gap there. So I don't know if they'll do it this time around, maybe because the economy is weakening and they want the markets to remain buoyant. They might just kind of be on hold. But, you know, the other problem I have is, you know, where valuations are, you know, we're going to see a lot more QIPs, block trades, IPOs. Everyone should take advantage of these kind of valuations, right? So that supply is going to really hit the demand side of it. And foreign investors are not going to rush back to India. There's 2 things they look at the moment. One is currencies, and one is the interest yields, or bond yields. So bond yields in the US, 4.5%, not coming down. Currencies, emerging markets, all depreciating. So there's no need to rush to emerging markets for the time being.
Yeah, that's true. And that's the telling point, right? We've been talking about in the studios that while we all said that, and rightly so, that the domestic investor and the domestic flow of money is the crutch on which the market stands, and the FIIs probably didn't mean too much. We just finally realized that no, the FIIs may not be the backbone, but certainly are important. So let's draw out the scenario then, Andrew. CapEx recovery not happening in a hurry, FIIs not coming back in a hurry, economy not quite gangbusters, even if not buckling down. Does that mean that the markets just about meander at these levels with a downward bias? Or could 2025 be a year wherein we see recovery from the lows?
So if you remember when we talked at the beginning of the year, we said, what would be the kind of nifty target? And I've said, it should be in line with earnings growth, which is about 10% for this year, which is about where we are, right? Now, if you expect more downgrades of 3 to 5%, then there's still a bit more downside for the markets to come. Looking to 25, 26, I'm not expecting earnings to be more than between 5 to 10%. So that's the kind of nifty target I would expect. So I think that the game is going to be where you're going to find those themes again, which are going to play out quite nicely over the year. So it's going to be more of a sector and stock picking rather than it's going to be an index, kind of where you're going to make all your money. It's going to be below the index, is my view.
I just want to come back to the point on FIIs, and I think that was important, that there's no reason for them to rush in to emerging markets. But at some point, I'm just wondering at what point that tide turns, and if so, how does India stack up? Because all of 2024, we've been hearing valuations are too high, too high, too high. Has that now come off?
Not to the, because I'm expecting more downgrades, so I still think it's too high. So India had a great run, right? If you take most of this year, it had China working for it in terms of everyone didn't like China. Now coming into 2025, if tariffs are less than we're expecting, particularly towards China, that's a big China trade, right? And we're all saying India, relatively to other emerging markets or other countries, is better off under Trump, right? But if it means that Trump is less aggressive with his tariffs, then all of these other countries come into play. So if you're an emerging market fund manager, you're going to say, okay, China's cheap, and they're going to do some more boosting for the economy, compared to India, where GDP is slowing, and there's not really an extra boost yet coming from the government in terms of capex spending.
No, so even in the scenario where Trump is stuffed with trades, but selectively more on China versus India, why does that not play out?
No, if you're talking about 50% tariffs, then yes, but then China will come and do something to boost their own economy, right? Okay. So there's always that play. So if it's less than 50%, let's say it's 30%, that's a big relief for China.
Correct.
And then they'll still do some stimulus, right, to get the kickstart the economy.
So it's a lose-lose in terms of where India
compared to a China play, yes, in terms of valuations and the potential for upside. And I think that's what foreign investors will look at. And of course, if that plays out, then of course, Korea and Taiwan start to come into the picture as well, because that means that the exports will start to increase, and particularly towards China.
So since people hopefully don't have Nifty futures in the portfolio, and I heard you say that the Nifty is not the game is below, right, underneath the hood. Where is it, Andrew, that you believe both earnings growth or a valuation re-rating or a combination of two could actually help that sector and specific stocks within that sector do well in calendar year 25 or the next 2 years, let's say?
Yeah. So for the next 2 years, I'm still on the same themes, which is premiumization in the beverage industry. I think that's going to continue. We're seeing it, people spending.
So liquor stocks, you mean?
Well, it can be non-alcoholic as well, right?
Okay.
Yeah, so it's the beverage industry. Hospitality, we talked about the kind of prices people are paying for rooms before we started talking here. So I think that's going to continue. Travel, experiences is going to be something that remains a kind of long-term theme within India. And don't forget, we haven't had the foreign travelers come back to the kind of levels pre-COVID. So that's the extra, I think, kind of help that the sector can get. And electronic manufacturing sector, I think, is just a great play over the very long term. If you think about the aeroplane just coming out of the hangar, it's not even on the runway yet. It's still to take off, and that's a long-term play. It's a bit like I would think like the telecom sector when you just had Bharti there at the very beginning. This is where we are with the electronic manufacturing sector.
Favorites there? Favorites there? I mean, apart the obvious Dixon, etc.
Yeah, so I think I think all of them have a different play within that kind of export and domestic sector growth as well. So I think you can have a basket of these companies and do well.
Yeah, but this consumption thing is interesting, right? Because, I mean, just the Asia millennial power to purchase. I mean, Diljit Dosanjh concert was crazy. I mean, the pricing was in some cases more than what you people pay for the Coldplay concert as well, and those tickets are also getting sold. So I heard you mention experiences, right? And therefore, would consumption catering to the millennial and the younger age be the driving force?
I think we're all seeing that, right? I mean, if you go to any kind of restaurants, there's either a tequila night, there's a sake night, there's something different, which is giving someone an experience of tasting different types of, we're saying liquor here, but yes, that's happening. It's happening, and I keep hearing of wine events that's going to start happening. So, you know, all of these things are starting to kind of be demanded by the consumer and saying, we want to taste more. We don't want to go the traditional way of how your mother and father was. We want to do our own tasting. And we don't care about brand. We don't care about whether it's Indian or foreign. If we like it, we'll buy it.
In terms of the experiences, premiumization trend, and I just want to juxtapose that with what you said about concerns about overall economic numbers. I'm just wondering if there's more juice in the platform stock story to go, because both the key players right now, Zomato and Swiggy, are bundling up with their experiences verticals. They're getting into events. That premium play is also coming in. Quick commerce is showing no signs of letting up. Is there more legs to that story, or we've played it out all of 2024?
No, I don't think we've played it out at all. I mean, if you go back, say, a year and a half before, we were talking about these companies, will they get to kind of a cash flow positive? Will they get to any kind of profitability? Now that, that exercise has been done and it's been proven. Now, if you had a long short, it'd be, long these companies and short FMCG. I mean, that's an easy way, because this is a trend which, again, is just going to continue to grow and grow. So
you have a long shot.
We have a long shot, yes. I'm not saying I've had that long shot, but I mean, that's the way I would look at this. I would say that these, platform plays are just going to continue to grow very, very quickly.
So they're also emerging out of the hangar and on the runway?
They're on the runway.
They're on,
and they're about to take off.
Okay, so they're a little further down than the others. Okay, so we've established short FMCG. I'm just wondering if there is any short-term take, free budget, etc., before, after, on your favorite themes like defense, railways, cap codes, or all of those are something that you'd wait to see if the numbers are really shoring up?
So those are sectors which will continue to get government contracts, don't get me wrong, but I just think that the government has slowed down the number of contracts. And if you look at these stocks, and actually you kind of look at when they receive a contract, the share price goes up. So there's no contracts being awarded, there's no catalyst for these, because it's all about execution then, right? So I like the capital goods sector, but I think after what I just read from Siemens, in the analyst view, is that they're actually giving you a warning that it's slowing down. We're hopeful, and we're all hopeful for a second half, which is going to be better, but I don't think it's coming.
Okay. Andrew, so what is an avoid? What is on the avoid list? Because you rightly mentioned valuations in some sectors that you like also are very expensive. EMS, the valuations are through the roof, but there is growth out there. Where is it that you believe that the combination of valuation plus low earnings growth makes it a distinct avoid?
So I think the paint sector is one, where I think there's a lot of competition, and that's not going to go away. I know it's a big area for growth, but I think the competition is just going to be very intense there. So I'm a bit nervous on the paints. And obviously, a lot of that to do with the oil price as well. Metals, if you think the dollar is going to be 108 to 110 DXY, then, commodity prices are going down. There's absolutely no two ways about it. So that's the other kind of trade you have to look at.
But if China stimulates, then that changes the equation a bit?
It's a very short-term kind of flip. So it's all going to be, that's why I'm saying it's not going to be quite business as usual next year. So the currency market and the bond markets are telling me to be careful, to be cautious right now. When Trump comes in, we can then take a more considered view of where we think things are going. And I think that's why I'm saying sit on a bit of cash is not a bad thing.
And use that cash for IPOs? I'm just wondering, is the primary market going to be the story in 2025? Because the last month of 2024 calendar year has been, I think, all about the primary market. And you mentioned it in the point of view of squeezing out, you know, all the cash out there because of oversupply. But is that where you'd want to deploy?
Listen, if I'm a private equity investor or investment banker, I would just be onto these companies saying, now is a great time to list. You'll be able to get these kind of valuations, which, you know, if markets were to turn for whatever reason in 2025, then, you know, that kind of window goes away from you, right? Because you're used to higher valuations. So I suspect that everyone's out there saying, list now, list now, list now. Wow. And that's what's been happening.
No, so don't buy. You're saying it from the investor banker point of view.
No, I'm looking from a, you know, obviously there's some companies there which will do very, very well, but not all of them. And I think you've seen that, you know, the listing of, a lot of them had that smaller kind of you know, premium now. Right. But a lot of them afterwards, you've seen that they're at a discount to the IPO price.
Yeah, it just peters out.
Yeah.
So is the IPO boom we're seeing the last people to leave the party, and then you wonder who gets, you know, left with the punch bowl?
Yes.
So that's pretty much what's happening.
We're all left with the punch bowl, right?
Okay.
The market's left with the punch bowl.
Yeah. Wow. I know you sound very skeptical. It's what's the quantum of cash you're sitting on currently?
I'm just cautious. I'm just cautious that, you know, we think it's going to be all okay next year. We all think we know what Trump's going to do. I'm not sure we do.
I don't think he himself might know.
And it's going to be a volatile first few months whilst he's there. So I just like the dust to settle, see what's happening, because it could actually, you know, not be a great year either. I know everyone's talking about, you know, US, but what if it just had that extra pop up, and then things go awry, and the valuations there are even more scary than our valuations. So imagine if the US market fell quite strongly. I think it'd bring the whole world down with it, because Europe's, where's the support in Europe?
True.
No.
Right? China we know, right? And so, you know, India might fall less, but it can't, you know, you can't go against this kind of rising tide of falling markets. So I'm just a little worried that we're all going into 2025 thinking it's all going to be good, business as usual, we're all going to, you know, come through it. Something else will happen.
Okay. You're striking that cautious note, which is, I think, very important as well as we, you know, continue to bring up all opinions and information to our viewers. But talking about punch bowls, here's to a great festive season. Andrew, always great to have you with us here, and in the studio even more so than ever.
Thank you so much.
Thanks,
Always
Andrew.
great to have the opportunity to be here. Thank you.
And season's greetings, Andrew. Have a great time.
Thank you.